We are at a huge inflection point for the US dollar, right here and now. It's one of those, does it go higher or lower moments, a big one. And the ramifications are considerable for most things, but especially gold and silver. Now, gold has quietly had an extremely good spring, coming off a textbook W bottom in March at $16.75 per ounce. It's marched over $200 higher through April and May, reaching $19.20 yesterday, where it's inevitably stumbled. Now, why do I say inevitably? Because $19.20 was the price it reached in 2011 after 10 years of bull market, one of the most epic bull markets in gold's history. It's a high that stood for 9 years until it was eventually, though only briefly, overcome last year. And it's such an obvious and long-term price point that gold was bound to at least stutter there, as it did yesterday. Now, gold looks good, it has to be said. It's grinding upwards. All the moving averages, short, intermediate and long-term, they're sloping upwards. We have a nice trend. Silver, too, is looking very good, and it's not often you hear me saying that. Currently, $28 an ounce. If it can get above $30, then a run to 50 looks like it's on the cards. Even the ratio of gold to Bitcoin is looking good, at least as far as the old money advocates are concerned, turning up after forming what looks like a long-term low over the spring. And that would all be part of this rotation we've been observing, from digital into physical, from growth into value, from new economy to old, from tech to commodities. Now, I view, as regular viewers will know, the incredible growth seen in technology since the 1980s as a function of the vast scalability of digital tech. One upload to Spotify or iTunes is effectively the same as getting 1 million or 1 billion vinyl records pressed in the 1970s. And money has poured into tech because of the quick returns it offers. And for the most part, as a result, tech has outperformed. Yet, within that broader trend, there have been windows when the physical economy has shone more brightly. The 80s and 90s were all about tech, but then between 2000 and 2003, physical outperformed. The rest of the noughties saw roughly equal performance, and then in 2009, tech began to outperform again, and that remained the case for over 10 years. Now, however, physical seems to be entering into one of its rare periods of outperformance, probably at least in part as a result of 10 years of underinvestment. Gold's recent outperformance, especially versus Bitcoin, would be a part of that recent rotation. So would the recent rallies in commodities. Tech will win in the end. Its scalability is just astonishing. But that doesn't mean physical can't have a couple of years in the investment sun. But real investment life is never as straightforward as vlogs about it might make it seem. The big potential fly in the ointment of this theory is the US dollar. Now, we can explain recent investment trends as a great rotation from tech into physical or whatever, but really much of it has just been a function of the US dollar, which is still the single most important price in the world, having had a couple of rotten months and a rotten last 3 quarters in 2020. The US dollar index, which measures the value of the US dollar versus the currencies of its major trading partners, peaked at 103 at the height of the corona panic in March 2020. This was the same peak it hit in 2017 at the end of Barack Obama's presidency and at the beginning of Donald Trump's. We got a huge multi-year double top, an M, and since then it's been in free fall, ending 2020 at 89. We had a relief rally to 93, which lasted up till March, and since then it's been in free fall again. Now we're back at 89, retesting the lows. These are the same lows which held in early 2018 and from which a huge relief rally followed. 2 years of bull market in the US dollar. The fate of the US dollar at the 88-89 level, it's currently retesting, determines the entire investment outlook for the next 2 years. If it holds, then it might be time to discard the great rotation theory. The secular bull market we appear to be at the beginning of in commodities may be off as well. If we fall below that level, however, the party is on. Buy metals, base precious, buy oil, buy the pound even. They'll all go a lot higher. Inflation, inflation, inflation. So what do you think? Does 88, 89 hold? Do we rebound here? Perhaps we pause for breath here and then head lower. Or perhaps it gives way straight away. Thanks very much for watching. Please subscribe to my channel. I'll be back with another video very soon. Until then, cheerio.